Record. Okay, so good morning, everyone. Thank you for being here this Wednesday. This webinar is being recorded. So after we're done, I can share with you the link. I will send all the attendees and participants the link on our YouTube channel so you can have it for, just in case. To watch it later. So my name is Sofia Bahana. I'm the project manager at the Minority Business Development Agency, MBDA. We support small businesses, minority-owned small businesses. And this is one of the things how we support it with great webinars. We have Amanda Davis here and of course, Frank Fernandez with the SBDC. So please feel free to reach out to us after the webinar. And of course, we will in contact with you. I just want to make a little quick announce is that after the webinar, we will giving free services away, 5-hour package with Amanda with one-on-one consulting services. So please take advantage of that, get in touch with me. And to get it short, I will introduce to Frank Fernandez for SBDC. She will talk a little bit about what they do. So take it away.
Okay, sounds great. Thank you, Sophia. Good afternoon, everyone. My name is Fran Fernandez. I'm the director of the Small Business Development Center at Central New Mexico Community College, the SBDC at CNM. And I just want to take a few minutes to share with you how my organization serves small business owners in our community. The New Mexico Small Business Development Center program was founded in 1989 and has been serving small business owners throughout the state for 34 years now. We have 18 small business development centers across New Mexico, and our highly skilled staff is comprised of 63 business professionals that have business management experience and business ownership expertise. The New Mexico Small Business Development Center program is a member of America's SBDC, which is the nationwide network that has over 1,000 small business development centers across the United States. Our program is funded in part by the Small Business Administration and the New Mexico State Legislature, and we do operate through a cooperative agreement with Santa Fe Community College to provide services to small business owners in our community. Our center's host institution is Central New Mexico Community College, CNM, and we proudly serve our clients located in our service area of Bernalillo and Sandoval counties. Our mission is to develop skilled entrepreneurs and strong businesses. The Small Business Development Center at CNM provides counseling and training services to help small business owners start their businesses, to help grow their businesses, and most importantly, to stay in business. Some of our services, our client services, include our no-cost confidential business counseling to help our clients in all stages of business development. We provide technical startup assistance to help businesses that, to understand the steps of starting a small business in the state. And we also work with existing businesses to help them to continue to thrive and to grow. We provide business and marketing plan development to help folks just basically, to work through the plans. If you're starting a plan, a business plan, a marketing plan, how do I get started and working through that process? Or, we can also review completed plans. We also can assess, different funding options and really trying to find the best funding that is available for our clients. We can work through the process and talk about that as well. We also provide market and industry research, as we have many tools available to help our clients understand the market that they're operating in as they move forward. My center also provides bilingual counseling and support services to our Spanish-speaking business owners in our community as well. And we do provide our low to no cost business education trainings through our online training portal on our website. As you can see, there's many advantages to working with the Small Business Development Center at CNM and also our community partner, the Minority Business Development Agency, as we really want you to succeed. We want our businesses to thrive and to continue to grow in our state. So I encourage you to please visit us online at www.nmsbdc.org, or you can, like I say, you can go online and check us out. You can see what our different services that we provide. You can sign up for assistance to our programs. Or you can just give us a call on our main number, which is 224-5250. And like I say, we really look forward to connecting with you very soon. So with that, after my intro, I'd like to go ahead and introduce Amanda Davis, and she is here to talk about bookkeeping. So we're really excited to have her. Thank you for being here, Amanda, and take it away.
Thank you very much. I'll go ahead and start sharing my screen now. Make sure I get the right one. There we go. Making sure I've got the right slide up for you guys, and we have everything. I'm gonna open up the chat and everything. So we're going to talk about bookkeeping. So I'm going to start off giving you some history, and then we're going to dive into certain things. And there's going to be a number of terminology and stuff like that. So this may feel like it's going really fast. Feel free to put your questions in the chat or the Q&A wherever you guys like, and I'll try to address them as we go. But I'm going to go ahead and get started. All right, so basically just kind of a general slide on how to get started here. What we're kind of outlining here, why bookkeeping, principles and practices, so on and so forth. A lot of the stuff I kind of talked about. And the training objectives to understand bookkeeping, the terminology, the financial statements, financial ratios, all of those great things. So to dive in, I'm kind of going to nerd out on you guys a little bit, but bookkeeping was formed in the 15th century with an Italian mathematician and a monk. So that's kind of interesting. And they created the double entry bookkeeping system. So if you've ever had any accounting classes or bookkeeping classes, you hear double entry. And so this is where it all started. So the basics of bookkeeping actually hasn't changed a whole lot from back when they originally started it. And they used to do it manually before there were computers, and they would do these recordings in actual books, and the books were called a journal and a ledger. Because bookkeeping is based on double entry accounting, transactions need to be recorded in two separate places, the journal and the ledger. Then the books have to be balanced each month. This is also known as the trial balance. This was done before before statements could be prepared. So that's just kind of an interesting history. We now have accounting software that simplifies it, right? They can pull in stuff from the bank. You can have rules and automation. You can capture images, all kinds of really interesting stuff. Now, what is the difference between accounting and bookkeeping? Because we use those terms almost interchangeably sometimes. And so basically, bookkeeping is record keeping and data management. And so that basically goes into record retention. How long do you record your records, right? There's general rules of thumb for 3 years, general correspondence, employer applications, internal audit reports, 7 years, bank statements, cancel checks, contracts, lease, that kind of thing. And then permanent, you want to include anything that's a tax return and the work papers associated with the taxes. Now, you hear with taxes 3 years and you're good, right? The IRS actually could go back indefinitely. So it's just, those are good records to keep indefinitely. And information, making sure the information in the books is accurate and reconciled. So those are kind of some general things that really set bookkeeping aside from accounting. Accounting takes those books and those financial statements, and they use that data to summarize the business's financial position, and they render advice, either financial or tax, that kind of stuff. They can prepare tax returns, they can do audits, and they can certify your financial statements, meaning if you have a lender or a buyer or an investor who wants to say, I want somebody to tell me that these numbers are right, they can go ahead and do that for you. That's the difference between a bookkeeper makes the books, the accountant uses the books to do these other accomplishments. Common bookkeeping tasks are data entry, office management, like billing customers, paying vendors, payroll, end of period closing, reconciling, adjusting journal entries, review financial statements, locking the books once the period is closed so that no changes can be made, internal management reports, balance sheet, income statement, statement of cash flow, accounts receivable on the aging reports. Those are kind of the general gist of what a bookkeeper would do. So I have this fun little picture of top mistakes and how to avoid them. When people, I'm a bookkeeper, that's my business. And so when people come to me, I could just see their face when they have this stress. So I wanted to get that emotion and get that image and maybe get a little laugh. So the SBA has a statistic that about half of new businesses fail within 5 years due to poor financial management. So really staying on top of it and understanding what it is can really help you with cash flow. It can really help you make smart business decisions, those kind of things. There's different types of accounting methods. So you can be on an accrual basis or a cash basis. We'll go into that a little bit more later on, but accrual is recording things as they happen, and cash is as money comes in and out of the bank. So just because you owe somebody money doesn't mean you've already paid them, that kind of thing. Intermingling business and personal. So if you have one bank account and you have all of your transactions going through there, your personal stuff and the business, that's a liability and an accounting nightmare. So if you're in that position, I highly recommend getting a separate bank account just for the business and keeping everything separate. Sometimes you're going to make mistakes. You're going to pay with the wrong, card or whatever. That's not a big deal, but really try to keep everything separate. And I mean, everything: PayPal, Venmo, Amazon, get separate stuff for the business. The more you separate your business from your personal, the easier it is to track and the easier it is on you in terms of if something were to go wrong and you have a liability, right? If somebody's trying to sue you. Misclassifying workers, that can be a very costly one if you're hiring an independent contractor, but you're not following the rules and they really should be an employee. That could be a problem. So the state or the federal government could come back in and say, absolutely not, this person's an employee, and they can hit you with back taxes, penalties, and interest. So that's fun. And then you're on their radar. So that's also not fun. Not reconciling accounts. A lot of people come to me and they're like, why do I have to reconcile my bank account? I look in there and I know what's going on. It's the first step of internal controls is making sure that everything at the bank and everything in the books agrees with each other, that you don't have anything duplicated, that you don't have anything in error, or you're not missing anything. So that's just the basic level. And because I would go in with one of my clients, I actually spoke to him yesterday. It's been a while since I talked to him, and he's awesome, but he had a little pay button on his website. And so some hacker or bot just did like a ton of $1 transactions. And even though those $1 transactions were fictitious, so kind of no harm, no foul, well, the bank fees were real and it actually cost him real money. And so I was able to get him ahead of it and say, hey, this happened. You need to go check on this. So that was that's one of the reasons you look and you reconcile. So lack of controls, making sure that physical assets and things like your bank account, that you have proper controls in place to safeguard for those. There's a construction company here locally that had somebody went into the office of the financial person, and they actually went into the drawer where the checks, they printed checks, so they had check paper, and somebody took from the middle of the pile and took a bunch of checks and was trying to write fraudulent checks, like to themselves or use the company funds, and they wouldn't have noticed those until they got to that middle pile, which could have been months later. So making sure that people don't have access to do bad things is a big deal. Misunderstanding the difference between what your profit is and what cash is. A lot of people are like, I have this much money in the bank, so that's how much money I made for the year, right? And the answer is not usually do they ever agree. What's in the bank is in the bank. What is income less expenditures, that is your net profit. And it sounds like, well, the income goes in the bank and then the expenditures go out of the bank, so why wouldn't that agree? Well, there's a lot of things that kind of go in, especially if you're not on a cash basis. If you're on accrual basis, there's cash that's not moving that you have to account for. And there's other non-cash transactions like depreciation. No money, you don't write a check to depreciate something. It just kind of loses value over time, if you will. And so because money's not moving there, you still have to account for that depreciation to get to your net profit. However, that's not going to be in the bank account. So there's lots of reasons why they would differ. Do-it-yourself bookkeeping. This is kind of like a good and a bad thing. I encourage people to do their own bookkeeping if they will keep up on it. If they will not, they need to give it to somebody else. But it's good to have your eyes in it. But if you're doing it and you're doing it wrong, or you're not paying attention to rules, or you're trying to cut corners, that's going to get you in trouble. Having no bookkeeping at all, no record keeping at all, is going to get you in a lot of trouble. Insufficient checks and balances. We talked about internal controls and a lack of an audit trail. So if something were to happen 3 years from now, and you don't have proper documentation or any kind of breadcrumb to help you out to figure out why did I do this, or why is this way, you're going to have a hard time with it. So that's really where we start. And now we're going to go into the terminology. There's a lot of terminology here. So we'll kind of get going down to brass tacks here, and I'm just going to go very, very fast. I will make this PowerPoint available if you guys would like, and this is also being recorded. And you also have the ability to possibly work with me on those 5 one-hour sessions that we talked about in the beginning. So if I go too fast, I apologize, but we only have 45 minutes and we have a lot more ground to cover. So the accounting equation is basically assets equals liabilities plus shareholders' equity. You're going to see that a lot. And it'll start making sense at some point. Accrual versus cash basis. So accrual is recording things as they happen versus when money moves in and out of the bank. Cash basis is when money moves in and out of the bank. So let's say you invoice a customer. That invoice is due not right then and there. They don't just invoice cash, right? A lot of times you have a little lag time between when you give them the invoice and when payment is received. And so if it's cash basis, you would only record that sale once cash is received. If you're accrual basis, you would record the sale once the sale took place and you invoice them. That is the difference. Assets. Basically, if you were to close your business today, assets is where you can take money out of the business. It could be your bank account. It could be equipment. It could be inventory. It could be a number of things that hold value. The accounts payable, monies that you owe to other people. So if you get a credit card bill, that's accounts payable. You have to pay that credit card bill. So that's what that is. Accruals, income, expense incurred but have not paid. We talked about that. Balance sheet, a comparison between your assets, equity, and liabilities. We talked about the accounting equation. Cash flow, money going in and out of your business. The chart of accounts, that's one we spend a lot of time on, especially on setup, and try to be very specific on it. But it's the listing of categories you use to classify your business transaction. Think of the chart of accounts as a sort of filing system for your business transactions. An example of a chart of account would be meals and entertainment. It could be office supplies, those kind of things. Cost of goods sold, money your business spends to produce income. So let's say you sell, you're a retail store, you sell t-shirts. The cost of goods, the cost of the t-shirt is part of your cost of goods sold, because it's basically, it's in the name. It's what you had to pay to get the sale. And so it's a direct expense relating to the sale. Double entry bookkeeping, recording transactions twice, meaning a debit and a credit. We talked about the ledger and the journal. Debits and credits. Each bookkeeping transaction has 2 sides. Remember, it's called double entry accounting. One side of the transaction is the debit, the other side is the credit. And I could go into what each one does, but I think that's a little bit more advanced than today. Depreciation, the write down of value of capital assets, like a vehicle. You know, the vehicle loses value over time, and so that's the exercise of writing that down, the depreciation. Equity or capital, there's a lot of terminologies, retained earnings, shareholders equity, there's a lot of names for it, but basically that is what is owed to the owner or shareholders of the business. Equity includes money paid in by the owner, money the owner has earned but has not taken out of the business, and other types of contributions like stocks issued. Expenses, money your business spends on operating and overhead. Fixed assets, these include land, building, machinery, equipment, vehicles. That's when we talked about depreciation, we talked about capital assets. That's another term for fixed assets. Fixed expenses, these must be met regardless of the sale level. In order, the order in which they are is not important, but thoroughness is. If some of the cost of small, let me just give you an example. I have like a long thing here and I'm kind of stumbling through it. A fixed expense is like rent. You're going to pay the same rent regardless of what you do. If you do nothing, you still pay the rent, right? If a utility is like gas is going to be a variable, and we'll talk about that later, but that varies depending upon the usage. So fixed expense means it's the same every time. General ledger, the ledger is made up of assets, liabilities, equity, income, and expenses. These are the 5 accounts comprised in the books of your business. A journal, daily business transactions recorded there before they go to the general ledger. Liabilities, what your business owes. So if you shut down your company right now, how much money do you have to close out and pay people? Like your credit card or another bill, maybe you hired a freelancer and they sent you an invoice and you have to pay that freelancer to close down your business because the money is in fact owed. Income and revenue, that's basically your sales. Payroll is a list of employees and how much you pay each one. Profit, what the business has earned after cost of goods sold and expenses are subtracted from income. Profit is not the same as cash on hand. We've had that conversation. Reconciliation, the process of verifying the balance of certain assets, checking, credit cards, loans, etc., against statements from an outside source, usually a bank. We are almost to the end. Subledger, a ledger containing details of a subset of transactions. An example of a subledger is accounts receivable and accounts payable. You have a balance on the balance sheet for accounts receivable and accounts payable. The subledger shows you the listing for every customer that owes you money, how much they owe and what they owe you for, how long they've owed it. Accounts payable is the same thing, but in reverse, money you owe to people, how much you owe them, why you owe them, all of those things. Trial balance statement that tells you if your debits and credits are accurate before you create financial statements. And variable expenses, these fluctuate with the sales level, increase, decrease. So like we talked about, rent, fixed, utilities like gas, the more you use it, the more you spend, that kind of thing. So that's the variable expenses. So let's dive into the financial reports. And I'm going to just kind of give us a breathing moment. Does anybody have any questions? I'm not seeing anything in the chat or questions. So again, if you want to raise some questions, do so. I've got those both open and I'm paying attention to them. The first place we're going to start with the financial reports is the balance sheet. So the balance sheet has your assets, your liabilities, and your equity. Assets are cash, equipment, that kind of stuff. Liabilities is your credit card payment, any loans. If you got an EIDL loan during the pandemic or in the recovery of it. And equity is what is owed to the owner. Profit and loss, we have revenue, less cost of goods sold, those direct costs associated with selling, creating the sales, and the expenses, which is everything else. Somebody like a bookkeeper would be under operating expenses and not cost of goods sold because you need them for the business, but you don't need them to get the sale. Okay. Aging reports, accounts receivable, accounts payable. We talked about accounts receivable is how much people owe you money. You have invoiced them and they have not paid you yet. And this lists out who they are, what invoices are outstanding and how much for each invoice and how long have they been outstanding. Accounts payable is the same thing in reverse. Who do you owe, for what bills, how much per bill, and how long have those bills been outstanding. And the statement of cash flow, it shows your cash receipts, your cash disbursements, and your cash on hand at the end of the month. All right, and so we're still diving into the financial reports. So this gives you an example, and I like the visual of this slide right here because you can see we talked about the terminology where it said assets equals liabilities plus shareholders' equity. You're going to see that a lot in this in this presentation, and this gives you a visual of what that looks like. Your total assets equals your total liabilities and shareholders' equity. You may have more liabilities, you may have more equity. It just kind of depends. I am seeing a question that pops up. DIY bookkeeping, can I just use my automatically sync bank statements in QuickBooks, categorize them? Yeah, so QuickBooks is a good example of one of the tools you would do for DIY bookkeeping. So that is basically everything comes in from the bank. And then you categorize it with a chart of accounts, and then you reconcile it from the bank statement, and then you have reports that you can use. So that's a great example of that. Okay, so assets, bank accounts, accounts receivable, fixed assets, other current assets, long-term liabilities. We were talking a little bit about depreciation. As a rule of thumb, anything $2,500 or more, you would want to capitalize. And that means make it a fixed asset and then run depreciation over the life of the asset. And it just kind of depends. Like a computer equipment has a different life than furnitures and fixtures than it would an automobile versus other different types of assets, that kind of stuff. Current assets and other long-term. So the term current and long-term, current, think a year, 12-month period. What is owed to you within 12 months? So your accounts receivable would be considered a current asset. If you have somebody who you lent money to and they need to pay you back, or some other thing, like let's say you had a 6 months CD or a savings investment at the bank, that would be a current asset. A long-term asset would mean something that's beyond the 12 months. So that's the difference. Liabilities is things that you owe money to. So it could be accounts payable, credit cards, lines of credit, loans, and the current or the long-term liabilities. A current liability would be like your credit card because it is due before 12 months. Long-term liability would be more like a mortgage, right? Because that is due and payable over a long term, more like 30 years. So if you got the EIDL loan, that's more kind of like a mortgage, and you're going to be paying it for a longer period. And then shareholders' equity, which can be exchanged with retained earnings, capital, that kind of stuff. And so what can happen in here, it depends on the legal structure of your business. If you're a corporation, you probably have stock. If you're a partnership, then you have, the different members and their different percentages of ownership, that kind of thing. If you're just a single member LLC filing on your personal tax return as a Schedule C, then that's just kind of members' capital. So this can include common stock, additional paid-in capital, and retained earnings. There's a lot of interchangeable things in here. So I'm going to move on to the next slide. So I wanted to give an example, and it's a little bit blurry, but I went on Google and looked for images of what a balance sheet would look like, and I broke it up to the 3 categories. So to drive home exactly the terminology that we're talking about in here, let's see, I'm going to pause a little bit. We have another question. Can long-term liabilities also be capitalized as a loan? So no, when you capitalize something, that's the difference between taking it as an expense towards your net profit, or capitalizing the asset. So an asset is something that you can get money out of. So if you're capitalizing something, let's say it's a piece of equipment, a vehicle, a computer, maybe you can sell that, right, at some point down the road. So capitalizing is an asset. So that's what that means. A liability is money you owe somebody, right? So it would be on the balance sheet, but it would be not under the assets. It would be under the liabilities. And we'll be looking at that at the next slide. So the balance sheet basics. So the assets, this gives you some examples of what assets could be, which I've done a number of times, but it's showing current assets, your cash, your accounts receivable, your inventory, and this gives you a total current asset. That means it's going to be collected within a 12-month period. And then the fixed assets, plant and equipment, accumulated depreciation, these are more longer term fixed assets because, the fixed assets do live under long term because you use them over a course of more than one year, right? Because if it was just 1 year, the use, it would just be expended, right? You would have an expenditure. So this kind of gives you a total of total assets. Here's another question. Are assets physical property that you can liquidate? Correct. So they can be, let's say you make things and you sew things. So if you have like a cutting table, that would be a fixed asset, right? It could be a vehicle, you can sell a vehicle. So it would be something tangible that you either purchased or acquired in some form. And you could, if you shut down the business, sell those things. Same thing with inventory, but inventory is something you sell. So you're in the business of selling a t-shirt. So that's inventory. But in order to sell that t-shirt, you need to have, let's say you bought a building and you're selling out of that physical location. That building is a fixed asset, but the shirt is an inventory, if that makes sense. Okay. I like to give real world examples. I find it to be a little easier. And so this would be the liability section here. So current liabilities, long-term debt, that kind of stuff. So accounts payable, accrued expenses, and other unearned revenue. These are other terms. I don't think we really went over that. Accrued expense is something that has incurred, but you haven't paid it yet. So let's say, for example, you know that you're going to be putting money into your retirement, but you're not going to do it until 3 months from now. That would be an accrued expense. However much money that you know you're going to be paying in, but you haven't paid it yet. Unearned revenue is something that maybe you have received money for. Somebody paid you like a down payment or a deposit or a retainer to do something, but you haven't done the work yet. So that means you haven't earned the money yet. You got it, but you haven't earned it. So that's what unearned revenue would look like. And it would be a liability because you haven't received it. Also because it's a credit balance, and that's where it would live due to the nature of that account. Long-term debt, like we said, those are kind of the EIDL. Any loan that would cover longer than a year. An automobile loan would probably be like that, and any other kind of long-term liabilities that you would see. And the equity section here, like I said, it really depends. This is a corporation example. It would be different if it was a partnership or a single member LLC or kind of a sole proprietorship, which is also different than like a nonprofit, which I don't know that we have anybody in that realm. But for this example, you have paid in capital, you have different types of stock. And so this kind of gives you some examples, and they usually put it like this. They actually list out what the specifics of the stock are, versus preferred versus common stock. These are other terminologies that you can kind of get into if you need to know about corporations and this section. The total paid in capital, then you have retained earnings, total paid in capital and retained earnings, and then there's treasury stock, which is a different kind of thing. You can have things like owner contributions, owner distributions, those kind of things in here. And sometimes if you did commingle and you had like owner personal expenses that went through the business, they would need to be put in this section so that they wouldn't be taken against and deducted against profit and to generate your net profit for income tax. So back to the accounting equation. This is just driving home all the different things. So assets equals liabilities plus shareholders' equity. Assets is what you own, liabilities is what you owe, and equity is what you get. That's a really, really downgraded way of just helping you understand what all these things mean. And the more you kind of work with it, the easier it is for you to get into. And then now we're going into the aging reports. And I thought this slide was really funny. I kind of enjoyed it because it says if an invoice is due in 30 days, we pay it in 60. If it's due in 60, we pay it in 90. If it's due in 90, then they probably don't need it anyway. So just kind of a little humor. So accounts receivable is money owed to you. It really shows you the listing of who owes you money, for what invoices, how much and how long, how old the outstanding balances are. The AR aging total should be the same that is reflected on the balance sheet. QuickBooks, well, it just depends. There can be differences between AR and the aging schedule versus the balance sheet. If somebody does a journal entry to accounts payables, some bookkeepers and accountants like to do stuff like that. That is a big no-no because then your subledger won't tie to the summary report, and the subledger is the accounts receivable aging report, and the summary report is the balance sheet. Same thing with accounts payable, just in reverse. Money you owe, how old your payments are past due, or how, if they're due or past due, if they are past due, and the accounts payable aging total should be the same as reflected on the balance sheet, just like the other one. All right. And so this is balance sheet at the top, but it's really the income statement. So I will have to correct that. But so now we're going into the income statement. It's also included the terminology profit and loss. And so there's lots of interchangeable terminology here. So this is the one you're probably going to spend a lot of time on, because the balance sheet is kind of the ownership, what's owed to you, what you owe, and like the collective ownership in the business as a going forward. The profit and loss is more of a snapshot of where you are at a certain period. It could be for the month, it could be for the quarter, it could be for the year. And so what the profit and loss really gives you is its revenues minus expenses equals your net profit or your net loss. If it's a negative number, you lost money. If it's a positive number, you made money. And the benefit for you making money is you get to pay taxes on it. That means if you're good in business, you're going to pay some taxes. Unless you have a strategic team of highly paid professionals who can help you navigate and reduce your tax liability legally. Revenue is your sales, your commissions, or any other way that you make money. The cost of goods sold is basically direct costs associated with a sale, meaning you can't make that sale without incurring that cost. Like you're selling a t-shirt. You can't sell the t-shirt if you don't buy the t-shirt. This could include materials. It could include freight to bring the materials into you, or the finished goods, or any other direct costs. Let's say you're building stuff to sell. Maybe you're an artist, so you would need to put labor in there, that kind of stuff. Then we get down to operating expenses, and I'm a bookkeeper, so I'm an operating expense. If you hire me, you would put it under bookkeeping, accounting, or professional services, something in that realm. Rent, if you have rent, advertising, payroll, office expenses, and any other type of operating expenses you may have, utilities. There's so many that you can. Is there also a cost of services sold? You can, if let's say you're a bookkeeper like me, you may have bookkeepers that are underneath you, as I'm the owner, and then I actually have 4 separate bookkeepers. And so their cost to me would really be my cost of services sold, right? Because I can't get those services. I can't get paid for my services if I don't pay my bookkeepers for their services. So it's less common to have a cost of services sold, but yes, you can do that if you do want to break that out. So thank you for that question. And then at the bottom below all the cost of goods sold and operating expenses, there's other kind of expenses that are not they're in the ordinary course of business. However, they don't relate specifically to the business you do. And so I'm going to give some examples of that. Interest and dividend income. If you have a savings account like a CD, like we talked about, and the bank pays you interest, or let's say you have some stocks or whatever as part of your portfolio, it's in your assets. Maybe you got some dividend income. Well, if you sell t-shirts, getting interest and dividend income isn't part of your business that you do. Now, if you're a bank, it is. If you lend people money, that kind of stuff. But if you're just a retail shop, interest and dividends has very little to nothing to do with the business, other than the fact that you have a bank account that pays you interest or dividends, right? And so that goes below the line of operating expenses. If you have penalties and settlements, there's other types of things, like, for example, if you sold a piece of equipment and you got some money, and let's say you actually made money after depreciation, then you would have a gain on a sale of an asset. But you're not in the business of selling assets, you're in the business of selling t-shirts. So because it's not part of how you operate and what you're in business to do, then that goes below. And then you have your profit or your loss, excess versus deficit. So total revenue less cost of goods sold, less operating expenses, plus other income, less other expenses equals your, at the end of the day, your total profit or your loss. A lot of people are seeing like other income when they had their PPP loans forgiven. A lot of that is being handled in other income for a number of places. That's how we were doing it for our clients. So that's kind of interesting. And then here is your profit and loss example. And this, I didn't break this out. This is the straight form. And so you can see you have $100,000 of sales and $75,000 of cost of goods sold, leaving you a gross profit of $25,000. That's $100,000 minus the 75. That gives you $25,000 to work with for operating expenses. So that's basically a 25% gross profit margin. If you want to get into the ratios, which we will kind of do at the end of the call. Selling, advertising. So these are the type of operating expenses. If you're paying commission expense, actually commission might actually be cost of goods sold. I would argue, so that might be misclassified here. Office supplies, equipment, that kind of stuff. And the other non-operating income, interest, revenues, gain on sale of investments, interest expense, loss from a lawsuit. So if you got sued and you had to pay that money out, that's you're not in the business of being sued, let's hope. So that would go into the other operating, non-operating category. And then we're going to get into statement of cash flows. Okay, we have another question here. Gross profit does not take into account operating expenses. Yes, that is correct. Your gross profit is your sales and your direct cost to make those sales. So it's you. This is how many t-shirts you sold or how much money you made from those sales. And here's how much money you bought buying those t-shirts. And the difference is your gross profit. So good question. Operating your statement of cash flows. And this is going to look a little different. When you think about statement of cash flows, you're thinking, okay, here's how much money I have in the bank. It's like a budget, right? And you're saying, here's how much money is going to come in, and here's how much money is going out, and here's how much money I need to make payroll or whatever it is you're concerned about. This is a little bit different. This is a little bit more technical. And so I'm not going to spend too much time on this slide because this is one of the more complicated statements that you will never use. Unless you really get into growing the business in a certain way, and you need to have this information. But basically what this does is it summarizes the movement of cash that goes in and out of the company, and it highlights ability to manage their cash. And it breaks it down into three different categories. So one is the operating activities, the investing activities, and the finance activities. So basically it's saying the money that moved, this bucket of money, this amount of money is just because you were operating your business. And this amount of money is how much moved because you made certain investments. And this is how much money moved because you made, because you financed certain things. And so it breaks it down into those categories. So operating would be sales, interest income, cost of goods sold, that kind of stuff. Investing, purchasing or selling assets, accounts receivable, accounts payable, that just kind of lives there. And then financing, dividends, stock repurchases, payments on debts and loans. Again, this is not an area that a statement you're really going to be using, especially if you're starting out. This is more of a sophisticated kind of stockholders, board of directors kind of thing. So when you get up to that level, it's assuming that's what your grand plan is in business, is to grow the biggest and baddest. At that point, you may be seeing the statement, and then you would actually be, oh, I remember that class when I was talking about the statement of cash flow. It's that weird statement that we're never going to use. Now we're using it. Here's an example of what that looks like. Again, I'm just not going to spend a whole lot of time, and we have about 15 minutes left, and I do want to make sure we have enough time to cover anything else at the end, including questions. So ratios, know them and love them. Okay. So the business's break-even point. Now the ratios we talked about, like gross margin, the percentage right here, revenue minus cost of goods sold divided by revenue. So it just tells you what your gross, how much money it is. And in certain industries, percentage wise, like what is your gross profit percentage? If you ever watch Shark Tank, you're going to hear some of these things thrown out that they talk about. So this kind of gives you an idea. And again, I will correct that one slide, and I will make this PowerPoint available, and this is also being recorded. So if we go too fast, or if you're not completely sure, you can go back and look it back up. So the break-even point is a really good base point for you to figure out how much money do I need to make to not make any money. So meaning how much money do I need to make payroll and pay my rent and this, that, and the other thing? How much money do I need to make to just cover those costs and not make any money at the end of the day? It's a break even, that you'd be going zero. And so this is taking your fixed cost divided by your profit margin. The current ratio this measures the liquidity of the business, its ability to meet certain obligations, those due during the course of the year. So the current assets divided by the current liabilities. That gives banks and investors and other interested parties an idea of, are you going to go bankrupt? Can you cover all of the stuff that you owe if you had to? Debt to equity ratio. This one evaluates a company's financial leverage, the ability of the shareholder to cover all outstanding debts in the event of a business shutdown. So this would be total liabilities divided by shareholders' equity. Okay. Then we have ROE. It's the quick ratio, I think. Oh, that's return on equity. I've got these out of place on my notes. Measure of financial performance. So basically, it's your net income divided by shareholders' equity. So this kind of tells you the better you're performing here, the more attractive it is to investors and to banks, lenders, that kind of thing. We talked about the gross margin and then the quick ratio. The quick ratio is also called the acid test, indicator of a company's short-term liquidity position, and measures a company's ability to pay its short-term obligations with its most liquid assets. So current assets less inventory divided by current liabilities. And then the working capital represents a company's ability to pay its current liabilities with its current assets. So you would take your current assets, you would reduce that by your current liabilities, and that gives you your working capital. With that, we have just over 10 minutes here. I'm going to open it up for final questions, comments, anything that you guys have. Okay, I think if you guys learned all of that, that's awesome, because I went through that pretty quick. So I'm going to hand it back over to Sophia to close us out. Thank you very much.
Thank you so much, Amanda. It was a great presentation, as always. So happy to have you and share your knowledge. Thank you so for that. And well, I see something. Okay. What others DIY software do you recommend?
The software we work with is QuickBooks Online. We work with that exclusively, but there's other programs. There's a program called Mint, like the chocolate chip, and there's a program called Xero. It's spelled with a Z, Xero. That's another competing one. And I think there's probably a few others, but QuickBooks Online is really a good platform to just, it really is intuitive, and it kind of helps you walk around. And if you do end up working with us, I can actually show you how to do it. So that's part of the one-on-one that we do. Looks like we have one more question too. Do you have a more extensive class that you hold? We haven't arranged that, but if it's in demand, I think we can probably work something out.
Yeah, probably in the future we can do that. But now, Teresa, I will say, if you have a specific questions to Amanda, take advantage of the 5-hour package to go more in detail with Amanda on that. So if there are now we're getting the questions.
They just had to get some gears going. Can we get the link of the video in order to watch it later? It went through very fast. Agreed. Yes, it was very, very fast. So I think you all will be having a link to the video. Can you use QuickBooks Simple Start? Yes, I highly recommend to go into one of the business suite. They do have what's called self-employed. I do not recommend self-employed. Simple Start is the lowest common one. So that would be a very, very good place for you to start. Thank you very much. Okay, thank you. All right.
Yeah, okay, so yes, after I get the recording downloaded, I will put it on YouTube in our MBDA YouTube channel, and then I will send an email to all of the attendees with the link to our channel so you can watch it later. And then also I will asking who will be interested on the 5-hour package. So please be aware of the email and reply back to me.
There's one question about what the 4 hours is. It's a 5-hour session. And we typically use it where you would get yourself QuickBooks online, and you would work with me or one of my trainers, and we would go through working in your QuickBooks. So you would share your screen. It would be virtual over Zoom, and you would get 5 1-hour sessions. But because I'm very flexible, we can use that time however you need. So if it's not specific to QuickBooks Online, but you have questions about business, that kind of stuff, we can use that time how you need it. So that's what's offered.
Yeah. Okay. So yay, thank you. Okay, yeah. So thank you so much, everyone, and have a great rest of your day.
Thank you, everybody.
Thank you.